Stop what you're doing right now. That 7% intraday crash in Brent oil overnight? It wasn't the start of a bear market. It was the biggest bull trap we've seen in 6 months. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use now. This isn't some vague analysis. These are the exact price points that institutional traders are watching right now, the same levels that will decide whether you profit from this volatility or get wiped out by the headline noise. Let me cut straight to the verdict, because I know you don't have time to waste. This session, we are fading that intraday sell-off with a medium-term bullish bias, but we are range-bound in the short term until we test that key support level. This is not the time to panic sell, and it's not the time to blindly chase the dip either. We have to be precise here. The only thing that will prove this entire bias wrong is a daily close below 92.33. If we break that level, the entire weekly structure collapses, and we are looking at a retest of $85 a barrel, fast. Write this number down. If we break 97.55 today, the whole structure shifts, and we are going to test that next support level before we can even think about bouncing. If you're trading oil today, that number is non-negotiable. You have to have it on your chart right now. If you've already written that down, type 97.55 in the comments right now. Let me know you're paying attention, because that's the most important level of the day. Now let's dive into the technicals, because that's where we separate the headline chasers from the actual profitable traders. Most people are looking at the 1-hour chart, panicking about that intraday crash, but they're missing the entire big picture. Let's start from the top, the longest timeframes, because that's where the real trend lives. The monthly trend? It's still a strong buy, no IFS, ands, or buts. We've been making higher highs and higher lows for 4 straight months. That strong buy signal hasn't flipped once, not even with this overnight crash. The 200-month average? It's sitting at 82.59, way below where we are right now. That's your long-term floor, the level that this entire uptrend has been built on since the start of the year. We are $17 above that level right now. That means the long-term trend is so far away from breaking, it's not even funny. Now the weekly chart, that's the next one down, and that's where we are seeing the real action right now. The weekly trend is also still a strong buy, same as the monthly. The 100-week average? That's at 91.69. That's the next level of defense if things go really wrong. That's the level I mentioned earlier. The 92.33 support is right around that 100-week average. That's why that's the invalidation level for the entire uptrend. And the 50-week average? Wait for it. That's at 100.14. That is almost exactly where we are right now, 100.21. We are literally testing the 50-week moving average as we speak. That's not a coincidence. That's the first line of support for the entire uptrend that's been in place since the start of the year. Every single time we've tested this 50-week average in the last 6 months, we've bounced. Every single time. That's the pattern we are seeing right now. This pullback is exactly the same as the ones we saw in March and April, where we pulled back to test the 50-week, found support, and then rallied another 10% in the next 2 weeks. That's the pattern most traders are missing right now, because they're too busy panicking over the overnight headline. Here's what most traders miss about this pullback. It's exactly the same pullback we saw in March, right after the conflict started, and then we rallied 15% in 2 weeks. The next signal changes everything, and it's happening right now at this $100 level. If you've been trading oil for more than a year, type OilVet in the comments. I want to see how many of you have been through these headline-driven pullbacks before. How many of you know exactly what I'm talking about when I say these crashes are just buying opportunities? Now move down to the daily chart. That's where things get interesting, because that's where the short-term and medium-term trends are colliding right now. The daily trend is neutral right now, and that makes perfect sense. We had that run up to 106 last week, right? We hit that first resistance level at 107.19, couldn't break it, and then we started pulling back. The moving averages on the daily? Let's walk through them, one by one, because they tell the whole story. The 5-day average is at 105.46, the 10-day is 106.71, the 20-day is 100.93. Wait, the 20-day average is right here, at 100.93, that's just 70 cents above where we are right now. So we've already broken the short-term moving averages, the 5 and 10-day, those were the ones that were driving the short-term rally, and now we are testing the 20-day right now. That's exactly why the daily trend is neutral. We are at the inflection point between the short-term pullback and the medium-term uptrend. This is the make or break point for the daily chart. If we hold above the 20-day, we bounce. If we break it, we test that next support at 97.55. Now look at the MACD. It's at 0.76 right now. That's barely positive. What does that mean? The short-term momentum has completely faded. The buyers that pushed us up to 106? They're exhausted. We've got negative divergence on the 4-hour chart, right? Price made that high at 106, but the MACD was already rolling over. That's the first sign that the rally was running out of steam, that the buyers were tapped out after that big run-up. And now, on the hourly charts, it's even worse. The 1-hour trend is sell, the 5-hour is strong sell. That's the intraday crash we saw overnight. But here's the thing, those short-term trends? They're just reacting to the headline news, not the underlying fundamentals. The weekly and monthly trends? They're still solid, because they're based on the supply and demand that's been in place for months, not a 24-hour headline about a peace deal that isn't even done yet, and let's not forget the RSI. The 14-day RSI is at 49.39 right now. That's neutral, exactly in the middle. A week ago, it was at 72, right? That was overbought. That was the first sign that we were due for a pullback, that we had gone too far, too fast, and we needed to flush out some of the excess. Now it's come all the way down to 50. That means we've flushed out all the overbought conditions. We are right at the level where the uptrend usually finds support. In the last 6 months, every time the RSI has dropped to 50 in this uptrend, we've bounced every single time. That's another confirmation that this pullback is exactly what we've seen before. It's not the start of a new trend. It's just a healthy reset after a big rally. Now let's talk about the levels, because that's what matters for your trades. That's what you need to actually make money. The first key support, the one I mentioned earlier, is 97.55. That's the first line in the sand. If we hold that level, we bounce right back up to test 105, then 107. If we break that, the next support is 92.33. That's the 100-week average we talked about earlier. That's the make or break level for the entire uptrend. On the upside, the first resistance is 107.19. That's the high we hit last week. If we break that, the next level is 111.81. That's the next major resistance that we haven't tested since the start of the conflict. And let's cross-check this with gold, because that's how you separate the geopolitical noise from the real inflation signal. That's the cross-asset check that most traders never do, and that's why they get whipsawed. For the last 3 months, oil and gold were moving in opposite directions, right? Oil was surging on the geopolitical risk premium, because everyone was worried about the Strait of Hormuz being closed. That would have taken 20% of global supply off the market. That would have sent oil soaring. But that same surge in oil prices was pushing inflation expectations higher, which meant the Fed couldn't cut rates, right? And that was killing gold, because gold is a non-yielding asset. When rates are high, gold doesn't look as attractive. When the Fed is holding rates high to fight inflation, gold can't rally. But now, that's changing. Now that the geopolitical premium is coming out of oil is pulling back. That means inflation expectations are coming down too. That means the Fed can actually start cutting rates again, which is exactly what gold needs to rally. So right now, we are watching those two assets start to recorrelate. After 3 months of decoupling, if oil holds that support at 97.55, that means the market is pricing in that the peace deal isn't going to fully remove all the supply risk, right? Because even if the deal is signed, it's going to take weeks for the physical barrels to hit the market, like the analysts at ING were saying yesterday. And that means inflation is still going to be a little bit sticky, which means the Fed is going to hold rates a little longer, which means gold is going to have support but not a huge rally. But if oil breaks 97.55 and heads for 92, That means the market is pricing in that all that supply is coming back online immediately, which means inflation is going to drop fast, which would mean the Fed cuts rates faster, which would send gold soaring even faster. That's the cross-check you need to do. Don't just look at oil in isolation. Look at what gold is telling you about the macro picture underneath all the headlines. That's how you avoid getting trapped by the news. That's how you see the real move before it happens. Now let's talk about what actually happened overnight, because that's the driver of this entire move, and that's what everyone is panicking over, but no one is actually analyzing. Last night, President Trump announced that the US and Iran had reached a deal to reopen the Strait of Hormuz. That's the news that sent oil crashing 7% in a matter of hours. Everyone was pricing in a military strike, right? For the last week, odds of an attack were going up. Everyone was worried that we were going to see a full blockade of the strait, which would have sent oil to $150 a barrel, according to some estimates. Everyone was loading up on hedges. Everyone was buying calls. Everyone was preparing for the worst. But then, overnight, the deal came out of nowhere, and all that risk premium just got flushed out of the market in minutes. That's the crash you're seeing right now. It's not a collapse in demand. It's not a flood of supply. It's just the fear premium getting taken out of the price. But wait, here's the thing. That deal? It's not done yet. There are still key disagreements, right? Iran is demanding sanctions relief. The US is demanding nuclear concessions first. The deal is tentative. It's not signed. It's not implemented. We've seen this before, right? We've had 14 different proposals from Iran. We've had talks that fell apart last week. We had talks that fell apart the week before that. This is not the first time we've had a headline saying a deal is imminent, only for it to fall apart 48 hours later. And even if it is fully implemented, the physical supply, it's not going to hit the market tomorrow. It's going to take weeks, maybe months, to get the shipping lanes back to normal, to get the Iranian oil back onto the global market, to get the infrastructure back up and running after months of disruption. And in the meantime, we still have those inventory draws that we saw last week. Remember the EIA data? Commercial crude inventories fell by 7.9 million barrels. That's way more than expected. The Strategic Petroleum Reserve? We withdrew another 10 million barrels. We are heading into the summer driving season, right? Demand is about to pick up, and we've got very little inventory cushion to absorb any shocks. That's why the weekly and monthly trends are still strong. The overnight headline? It just removed the fear premium. It didn't fix the underlying supply and demand imbalance. And let's talk about the analyst forecasts, because that's another piece of the puzzle. Barclays just raised their 2026 Brent price forecast to $100 per barrel, right? They said that if the current disruption continues through the end of May, forward prices could reprice to $110 a barrel. That's right, even with this peace deal, they're still targeting 100, because they know the underlying supply is tight. And that's exactly where we are right now, at 100.21, that's almost exactly their target. That means the long-term price is already where the analysts think it should be. The only thing that's moving it right now is headline noise. And what about the UAE exiting OPEC? You heard that news a few weeks ago, right? Everyone thought that would mean more supply, but Barclays said that actually, it could help narrow the medium-term gap between non-OPEC supply and demand growth, but it's not going to fix it completely, and it's going to come at the expense of spare capacity. That means we have less of a buffer if we get another supply shock, which means oil prices are going to stay high for longer, no matter what happens with Iran. And let's look at the institutional positioning, because that's another thing most traders are missing. The ETF flows? For the first quarter, we saw $167 million inflow into BNO, the Brent oil ETF. The shares outstanding went from 3.5 million to 18.35 million. That's institutional money piling into oil, because they know the long-term supply story. Even this week, as we pulled back, the smart money is still buying the dip. The put-call ratio on BNO, it's still call-skewed. That means institutions are buying calls, betting that we are going to bounce back from this pullback. They're not selling, they're buying the dip, because they know that this overnight crash is just headline noise, not a change in the long-term trend. And the CFTC positioning data? The latest data shows that speculators are still net long Brent oil by almost 300,000 contracts. That's right, the big money is still long, they haven't flipped to short. The only thing they did was take some profits off the table after we hit 106. That's why we had the pullback. They're not exiting their positions, they're just reducing their exposure a little bit after the big run-up, waiting to buy the dip. That's exactly what you should be doing too, right? The smart money isn't selling, they're buying the dip, because they know the long-term story is still intact. So for the next 1 to 2 weeks, my directional lean is bullish. I think we are going to find support here around 100, bounce back up to test 107, because the market is going to realize that this deal isn't the silver bullet that everyone thought it was. We are going to see that the deal has holes, that there are disagreements, that the supply isn't coming back as fast as everyone thought, and we are going to see prices bounce right back. But what would invalidate that thesis? If we get a full confirmation of the deal, all the sanctions are lifted immediately, and we see Iranian oil flooding the market, and we break that 92.33 support level on a daily close. If that happens, then we are looking at a much bigger pullback, all the way down to 85, maybe even lower. But right now, the odds of that are very low, because the deal is still fragile, there are too many things that can go wrong, and don't forget the product inventories. We've got gasoline inventories, diesel inventories, they're already at multi-year lows. Last week, we saw that refined product inventories fell by another 3 million barrels, right? We are heading into summer driving season, demand is going to go up by 2 million barrels a day, and we've got no inventory to cover that. Even if we get Iranian oil back online, it's going to take months to build those inventories back up. That means even if the geopolitical risk goes away, we are still going to have tight supply and demand, which means oil prices are going to stay above 90, no matter what. That's why the long-term trend is still up. That's why the monthly and weekly charts are still strong buy. This isn't 2020, we don't have a demand collapse, we don't have a supply glut, we have the opposite. We have tight supply, rising demand, and very little buffer. That's the story that's not going away. No matter what the headlines say today, most people will skip this, but this is where money is made. Keep watching. I'm going to give you 3 exact strategies for conservative traders, active traders, and aggressive traders, so no matter what your style is, you have a plan today. No more guessing, no more panicking, you have exact entries, exact stops, exact targets, so you know exactly what to do, no matter what happens next. First up, strategy 1, the sniper. This is for the conservative traders, the ones who don't want to chase price, who want to wait for confirmation before they get in, who don't want to take any unnecessary risk. The exact trigger condition? Wait for a daily close above 101.50, with a 4-hour candle closing above the 20-day moving average at 100.93, and the MACD turning back up on the hourly chart. That's your confirmation that the support is holding, that the buyers are coming back in, that the intraday sell-off is over, that the dip is done. You don't enter before that, you wait for the confirmation, because you don't want to catch a falling knife. You want to make sure the trend is turning back up before you put your money to work. Now, your stop loss? You put it exactly at 97.40. That's 15 cents below that key support level at 97.55. Why there? Because if we break that support, the setup is invalid. We don't want to be long anymore. That means the market is breaking down, that the support didn't hold, and we're heading lower. The risk on this trade? That's $4.1 per barrel. For a standard Brent contract, that's $4,100 of risk per contract, which is why position sizing is so important. If you've got a $100,000 trading account, you risk 1% of your capital, that's $1,000. That means you can trade 0.24 standard contracts, or 24 of the mini contracts, which means you don't over-leverage, you don't blow up your account if the trade goes wrong. That's non-negotiable. No matter what strategy you use, you size your position so you only risk 1% maximum now. Your targets. Target 1 is 105.90. That's the 20-day moving average we talked about earlier. That's the first level of resistance. That's where we are going to see the first profit taking. The risk-reward ratio here. That's 1.07 to 1, not great, but that's just the first target, that's the easy money. Target 2 is 107.19, that's the recent high, that's the next major resistance, that's where we were last week before the pullback. The risk-reward here. That's 2.39 to 1. That means for every dollar you risk, you make almost $2.4. That's a great risk-reward for a conservative trade. That's the kind of trade that prints money over time, because you only risk a little, and you make a lot if it works. And what voids the setup? If we break 97.55 intraday before we get that entry trigger, if we see the deal getting fully confirmed, or if we get a huge inventory build that no one expects. If any of that happens, you walk away, this setup is dead. You don't force it, you wait for the next one. Next up, strategy 2, the active trader. This is for the ones who trade the daily ranges, who want to get in now, not wait for a close, who want to capture the intraday bounce as it happens. The entry condition? We enter right here, at current price, 100.21, on the pullback to the 50-week moving average. This is a mean reversion trade, right? We are betting that the 50-week average is going to hold as support, that the buyers are going to step in here, that this level is going to hold, just like it has every other time we've tested it in the last 6 months. This is for the traders who don't want to wait for the daily close, who want to get in early to get a better entry price. Now, your stop loss? You put it at 97.30. That's 25 cents below that key support level. Why? Because if we break that support, the mean reversion trade is over. We are going lower. You get out immediately. The risk here is $2.91 per barrel, which is $2,910 per standard contract. Again, position sizing. For a $100,000 account, 1% risk is $1,000. That means 0.34 standard contracts, no more, no over-leverage. Now, your targets. Target 1 is 103.12. That's the first level of resistance, the halfway point between here and 107. That's the first level where we are going to see sellers step in. That's where you take your first profit. The risk-reward here is 1 to 1. That's a 1:1 trade, which is great for an active trade. You risk 1, you make 1, that's a win right there. Once you hit target 1, you move your stop loss up to break even, right? You lock in your risk, so you can't lose money on this trade anymore, no matter what happens. Then you trail your stop loss by $1. So if price pulls back, you lock in your profits, you don't give them back. That way, you can let the rest of your position run, without risking any of your capital. Target 2 is 107.19. That's the same high as before. The risk-reward here. That's 2.4 to 1. That means if we hit the second target, you make $2.4 for every one you risk. That's a home run for an active trade, and after this strategy, I want you to do something. Let's see how aligned we are. Type your Brent oil range for tomorrow in the comments now. I'm reading them. I want to see if you're seeing the same levels I am. Drop that number in the comments right now. It helps the algorithm, and it helps me see what you're thinking. I go through these comments every day. I reply to as many as I can, so drop your range. Let's see how we stack up. Now, strategy 3, the aggressor. This is for the high-risk traders, the ones who want to trade the short-term momentum, who don't mind a little volatility, who know how to manage risk fast. This is not for beginners. This is for the traders who have been doing this for years, who can take a small loss and move on without panicking. This is a counter-trend fade of the intraday sell-off. We are betting that the intraday low is in, that we are going to bounce hard from here. Fast, the entry condition? We enter right now, at 100.21, but only if we get a 1-hour candle closing above 100.50, that's the confirmation that the intraday low is in, that the buyers are stepping in, that the sell-off is over. Your stop loss? Tight, at 99.10, that's just $1.4 of risk. Why so tight? Because this is a short-term trade. You're betting that the intraday bounce is starting. If we break that low, you get out immediately. No questions asked, no hoping, no praying. You just exit, take your small loss, and move on. The risk here is $1.4 per barrel, which is $1,400 per standard contract. So for that $100,000 account, That means 0.71 contracts. That's the max you can trade without risking more than 1% of your account. Your targets? Target 1 is 102.50. That's the first intraday resistance. That's where you take your first profit. Risk reward 1.71 to 1. Target 2 is 104.80. That's the next level. That's where the next resistance is. Risk reward 3.29 to 1. That means for every dollar you risk, you make almost $3.3. That's a huge risk reward, but it's high risk, because it's a short-term trade. It can reverse fast. And I have to say this explicitly, only for those who know how to lose small and manage risk aggressively. This is not for beginners. If you can't handle a $1.4 stop, if you can't get out fast when the trade goes wrong, don't do this. This is only for traders who can take small losses and move on, who know how to manage their position size, who don't over-leverage. If you're a beginner, stick to the first two strategies. They're safer, they're more reliable, never risk more than 1 to 2% per trade. No positions through high-impact news like the inventory data coming out this week. Stops are non-negotiable. Don't move them down to hope for a bounce. That's it. That's all the risk management you need. If you follow that, you'll stay in the game long enough to make the big money. Now let's wrap this up, because I know you need to get back to your charts. The most critical level for the next session? That's 97.55. That's the line in the sand. If we hold that, we bounce. If we break that, we test 92.33. That's the number you need to watch tomorrow. That's the number that will decide everything. Tomorrow, we've got the EIA inventory data coming out. That's the big event. That's going to tell us if the inventory draws are continuing, if the supply is still tight. That's the next catalyst. That's what's going to drive the next move. If we get another big inventory draw, that's going to send oil right back up to 105, fast. If we get a build, that's going to push us down to test that 97.55 level, and if you want the full breakdown on gold and how it's reacting to this oil move, that video is live right now. Check the end screen. It's got the exact levels for gold too, so you can cross-check your trades. You can see how that cross-asset correlation is playing out, so you can make sure you're positioned right across both assets. That video is packed with the same kind of actionable levels, the same kind of analysis, so go check that out after this one. Smash like if this analysis gave you a clear plan, if it cut through the headline noise and gave you exactly what you need to trade today. Subscribe and hit the bell for daily coverage. We cover 8 key assets every single day. We give you the exact levels, the exact setups, the exact analysis you need to profit from the volatility. No fluff, no nonsense, just actionable trading intelligence. I'll see you in the next one.